Hello, Business 635 students. It's my week 8 update video. It's Friday, February 28th. This is a short video talking about alternative capital resources, which is our topic for this week, and case number 4, which is due next Wednesday, March 4th, I believe. March 4th? March 4th. I also will be having a video explaining case number 3 tomorrow. I'll be posting the grades for case number 3 tomorrow, and you can use that as a review prospect for the electrics case and our review session this coming Sunday on the Laverne campus from 1 to 3 o'clock in the Wilson Library, room 160. Or you can attend that review session online with WebEx. The link is in your WebEx links in Blackboard. Again, that is a review session for all 635 students this Sunday at 1 o'clock. I'll have a brief lecture on the topic of the electrics, and then we'll answer questions that you may have about the case. But before we get to that this weekend, let's just look at a couple examples, and this is included in this video about alternative capital resources. Different ways company can get capital, which will include different costs, different risk, and different ways of getting assets for a corporation. We've talked mainly about the traditional methods thus far in this class. The use of debt, both short-term or long-term debt like bonds and mortgages. We have talked about equity, either private venture capital equity or public equity, which is a little bit about what we're talking about in Chapter 18, initial public offerings or secondary offerings of stock, something that you probably do not want to get into after the course of events on Wall Street this past week. And then the third form of traditional fundraising is making profits. The retained earnings that you keep, less the dividends, is the amount of capital you have generated internally to the use of purchase of assets. And those have been part of our discussions in cost of capital and thus far in this course. But beginning in chapters 18, 19, 22, and 24, we talk about alternative resources. Case number 4 involves a little bit of about this, and I wanted you to be aware of this for future studies. First of all, the chapter 19 and the lease. Lease payments. Instead of making asset or debt payments on an asset, you lease or rent the asset. We have two types of leases, an operating lease and a capital lease. The main difference between the two is the operating lease does include maintenance, where the capital leases do not. Positive aspects of leasing, the use of assets without a debt load. You can use assets without the borrowing of money. You rent them. The negative aspects is for larger corporations and larger purchase of assets, naturally, no tax deductions. No tax deductions on the interest, no tax deductions on the depreciation, so thus no extra cash flow in generating of that asset. Chapter 18, we talk about the issuance of stock, public offerings of stock, going public, where you get an investment banker and you go out and raise money. Mainly that is an initial public offering. What we've been talking a lot lately is secondary offerings, where a company's already been established. They're going out in the market for another stock issue for a particular purpose, like a particular asset or a particular new area of the company. But also there is going public for the very first time, initial public offering. I highly doubt it with the events in Wall Street this past week. IPOs will be rather limited over the next couple weeks until this market gets straightened out. The positive aspects of going public, of issuing stock, are obvious. You have increased sources of capital. You're more liquid in cash. You have a greater diversification of investors. And also, the issuing of stock is public relations. You put out an annual report. You report quarterly your financials. More people know about your company. The negative aspects of going public, naturally, you have increased costs. The use of reporting of financial data, the investor relations department, huge cost factors in going public. You have more reporting requirements. Every 3 months, you have to report your financials to the market. Every 3 months, you report your next year plan of operations. And also, you lose control. The more stock you offer, the more shares of stock outstanding. Investors lose control of the company too, because there's now a huge amount of investors. Going private. Many times companies say, the hell with this. I'm going to go from public to private. And the main source of that is called a leverage buyout, where you use the assets of the company to obtain loans and debt from financial institutions and use that debt to buy out the stock of your investors. It's called leverage buyout. The positive aspects of leverage buyout is more management power. Management now owns the company, not the stockholders. It gives them more control of the business operations. They don't have to report to a board of trustees, or a board of directors. There is, though, increased leverage. You're borrowing an awful lot of money to take control of the company from the shareholders. That can sometimes stretch a business. Many times you see in a leverage buyout, a company will split up and sell off parts of the business to be able to pay back some of the debt they incurred to do the buyout of stock. And naturally, with less reporting, you don't have to report every 3 months. The only time you have to report when you're a private funded corporation is your tax return. You are not required to file financial statements every quarter or annual reports. Just file your tax return. And then finally, the mother of all alternative capital strategies is mergers. Mergers and acquisitions. We read about it every day in the newspaper. Companies merge. Companies combine their resources with another company. The main reason for that is because you want to reduce your cost, be able to get into new markets, new products, new technology. It happens every day. 4 types of mergers you should be familiar with: horizontal, vertical, congeneric, and conglomerate. All different ways of acquiring assets. Also, instead of merging, you can acquire. Hostile versus friendly takeovers. One of the reasons Microsoft and Google have become so strong in their markets is they went around and buying up their competition, buying up the products, and taking those products and bringing them under their umbrella and calling them Google, calling them Office, calling them the cloud. That's how these companies control the markets, by buying up their competitors. Hostile takeovers. Interesting subjects, to say the least. And then in chapter 24, bankruptcy. 2 main forms of corporate bankruptcy in America. Chapter 11, which is reorganization of a company. It's basically a timeout for the company to reorganize their finances, their debt positions. A great example of that is 2008 General Motors. Another form of more drastic bankruptcy is liquidation. You end the existence of the company. You sell it. Chapter 7. Chapter 7 is liquidation bankruptcy, where no more restructuring. You sell off the assets and pay off the liabilities as much as you can with whatever is left over. A great example of that is the 2013 liquidation of Blockbuster Video. Thank you, Netflix, for doing that. But be that as it may, those are all alternative financing, which we're talking a little bit about in case number 4, and we will discuss our last few weeks of our class and leading up to the conclusion of our class in a couple of weeks. So there's a brief review of that and things that you should know about that and things that are being talked about in your case number 4. And speaking of case number 4, here it is right here. Again, this is due Wednesday. No format is desired. You either can answer in a separate file or answer on the case study sheets, however you see fit. One question on lease financing. We talked a little about that here. Another question on if you were starting a business today, would you? Boy, that probably has changed in the last week after the events of this past week with the virus and with the state of the market. That might have changed your mind a little bit, but I want a 2-page description of that. Some of that could include some of the discussions that I just made of alternative capital strategies. Would you or would you not, and why, open up a business today? Who are the typical beneficiaries of a merger? Give a real-world example of a successful and unsuccessful merger. Go to the real world, go back maybe 10, 15 years, 5 years, pick an example, write a paragraph or two about the successfulness or unsuccessfulness of that merger. Please do not use, everybody's probably going to pick certain ones. That's okay, but try to find different ones. Try to find some that a lot of people haven't heard about. That would be to your benefit as far as grading is concerned. So that's our case number 4. A review of mergers, a review of how would you start a business today, and lease financing. No discussion of bankruptcy there, but it's still a good idea to understand the basic definition of the corporate bankruptcy for future classes down the line, more specifically your 695 ending seminar course, which you have a lot of discussions about bankruptcy in that. So that's our video for this Friday. As you can see, the hockey game is behind me. I got to get back to it. The Rangers are playing the Flyers. Very important. But I'm finishing up the grading on case 3 tonight. We'll be putting that together tomorrow. And I'll probably be seeing a few of you at our review session, either WebEx or on campus on Sunday afternoon. Thanks, everybody. We'll talk to you again. Bye-bye.